So let's cover a few things now. I, as always, update my posts. I'm just going to touch on oil to start with. In this particular post, okay, you will have seen me draw out these levels up here. These are very ideal for shorts because they'll run within that longer term downtrend. And you can see that we've got a candle dropping already. So we're going to look at what's going on there and why and how to deal with it. And I'm going to cover a few important things as well. If you can hit the like button, guys, when you come on in, and as I say, click below to get started. Join the Discord if you want to, and come and chat. So on oil, what you've got at the moment is you're running a downtrend from up here. Okay, this is now turned into a downtrend because you can see that you're getting lower highs, lower lows, right? We can all see that on the chart now. You had a push up once, didn't get beaten, okay, and it stops. Now, it's important to understand that your time frame, if you're looking at trends, needs to be relevant. So if you zoom out on your daily, yes, you can see it's still an uptrend on the daily, but to clear your mind of why that is, if you just go to the monthly, okay, obviously it changes again and you can see it's an uptrend. So it's uptrending on the monthly, but it might not be on the daily, and that's because the rule for an up or down trend takes the previous highs and previous lows, and obviously then if you've got consecutive lower lows and lower highs, then you've got downtrend, and vice versa for an uptrend. So what is significant on oil at the moment? Well, we had a rise from here where we looked long. Great, we took that. Now what you've got is you've got a bounce off this 200 MA on your daily chart, but the issue is that you've only come down to you've gone from 835 really $83.50 to 79.40 a barrel. Okay, so you can see just by looking at that the fall is not very far, and in fact if you just connect the dots, if you like, okay, that is what it looks like. Now that obviously is not a very far dip, and therefore if you're buying it too high. It needs to come back much further, and I would say just because this level here has been very reactive, that might be ideal for longs in the future. Okay, so we really want to see oil come back a bit more, and otherwise if you don't want to deal with it like that, just follow the post, what I was talking about before. Just let it ride and come up. Now, I did just do a blog on this as well. The blog I just posted in my Discord channel and chat tells you all about this, okay? Some guys, and I think it's really naive to do it on commodities and things like oil, they will just ignore the sentiment on this. They'll ignore why the price fell here, okay? And why it fell from here and why it rose from there. They'll ignore it because they're not interested, okay? They're really not interested. Now, that's a problem because oil is just completely ran by supply and demand of oil, unsurprisingly. So you can see the longer term direction is down because there's a drop in demand in oil. And the longer term direction was up from here because there was a growing demand in oil. We all saw it completely capitulate, just completely get annihilated around COVID time, and the demand goes up. Okay, and then you obviously got the war and the demand's too high. So what you're looking for is a retracement in demand, if you like. Yes, it is the price, but really what you're trading here is demand, until you get to a point where people start to sell again, and that comes within that longer term downtrend I was referring to. Okay, so if it's like that, and that's what you see throughout history, the same thing. It's a change from demand, supply, or people buying and people selling. And that's what the blog I wrote was completely about. Can't see any questions in here. I don't know if this is frozen, but just let me know if you're stuck. Okay, so what we're looking at with oil is a rise here. Don't buy it. Okay, I'm not interested in buying. I might look slightly long, like I said, if you get a feasible dip to those previous long zones we saw before. Okay, but otherwise I would just hold off, let it do its thing. Now, the other important lesson I was going to discuss today, again, I'll do it on gold, and you can see much of the same thing. Like oil, this fall is not significant yet. Okay, and if you drop that time frame down to the daily, you can see that again, it's stumbling. and it's stumbling because of the recent price action. This recent price action is not strong. Okay, it's quite weak, and therefore, you're not looking to massively suck through first. But eventually you'll come lower, and you could take it long 1950 area, I would say. The reason being is because that's your earliest feasible PA zone around here. Okay, it's more or less this. But even so, I wouldn't be interested in buying a lot. Now, the actual lesson I was going to discuss, and the juicy bit, if you like, is just regarding the long-term aspects of trading, how to stay afloat long-term. And I did a blog about this yesterday as well. It said, how to not get margin called. And it's just because on this move, so you've got something like this, okay? You come up all this way, right, 25%. Now, starting off from here, what you would have had is you would have had people who bought it, which is what we said, which is great. And we did the same thing here. We all know that. I got an editor's pick on it. We were short around here and everything like that. But what you find is, we're short there. What you find is, as the price comes up, people start to get short. Now, when they get short, and these red lines are basically shorts, if you like, what happens is their drawdown grows. Okay, so as the price comes up, your drawdown, or basically how much money you're in loss, will grow. Now, that's a problem for a lot of people because they don't know how to sustain that. Okay, so as the price rises and you get higher and higher, like this, the losses will grow. Now, to be profitable as a business, okay, trading is a business, if you like, and I speak about this all the time, lots of guys in my academy know, you need to be able to sustain the move, really, whatever it does. I mean, it's not going to do a lot that once every 20, 30, 40 years, it will do an extreme move. But even so, you need to be able to sustain any rise in price, because if the price keeps going against you as it is now, and you can't sustain those shorts, you're going to bust. You're going to get a margin call and you're going to close out. So if you're pretending that can't happen, okay, and the price can't do that, you're kidding yourself, because it can and it will. And I'm sure a lot of people on here have seen that before. Okay, people who aren't in my academy, or who are brand new, or who are thinking of joining, won't have seen anything like this. Okay, I mean, they will have seen it and they know it can happen, but they still don't change their trading decision. And people forget what happens to them, and they put it down to chance, and it never is chance. Okay, it's literally just the way things work. So you need to get yourself in a position where you can sustain that drawdown. And I want a neater text. The anchored texts are far more pretty. So you need to sustain that drawdown. Okay, and that drawdown needs to be sustained from this point, okay, all the way up to here. In other words, if you start shorting and you can't survive a move that high, and you keep adding and adding and adding, you get short and short, and you over leverage, you'll bust. You'll get a margin call. So you have to be aware of the maximum size that you're going to trade at any time. Okay. So you need to know your max size based on capital. Okay. Your drawdown limit. Stop adding. Okay. And this is all discipline. You don't necessarily need emotions to do this, and this often stops emotions from taking over. Okay. So you need a maximum size per trade, and you need a drawdown limit. Okay. And you need to hedge where necessary. So on those dips, you need to take advantage of them, and you need to know how to do that. So if the price does dip back like that, you can get long, and you can mitigate those shorts, and you can rebuy as the price goes up. Okay, and that will stop you being exposed too much, and you can exit losers early. Okay. So you could exit bad trades with no loss or minimal loss, and those things allow you to keep trading long term. They allow you to run that business. And if you don't have that, you've got no business. You know, you wouldn't have a company most of the time running enormous risks so that they'll go out of business if they don't achieve a certain thing. Okay, so if it turns out they can't get the sales or whatever, or they can't get the supply, or they're losing money, they'll go out of business. A lot of them plan for that. They've got risk plans, and you know, hedge funds, big institutions with a lot of capital to use, they've all got risk plans. You just can't trade without risk plans. You are literally running a ticking time bomb. You will lose all your money. You will absolutely lose all your trading capital if you do not plan for harsh moves. And harsh moves are inevitable. They will always happen. Doesn't matter what you're trading. Okay, UK index here. Look at that. You've gone from 7,200 to 7,925. So that's 725 points. Now I'm trading this and I am short. I'm short down here. I'm short down here, but I'm hedging. And I'll hedge on these falls. Okay, and you can see how the market has stopped. And that gives you a chance to hedge. Look at all the times it stops and you could have bought. Okay, and I can reduce my exposure and stop myself from being in danger, pretty much. That's how this works. So it's the same for any asset. You know, you had it with your dollar yen. You needed to hedge there. You need to hedge there. Okay, you need to stop adding early so you don't get crunched. And then eventually the market does fall and you're okay. So that accumulated hedge gains allows you to stay afloat and stay above water. So that's today's lesson, really. I'll brush on crypto just for a minute. You know, you're coming down to early PA there. Wouldn't be surprised if you dip between your 20 and your 40 there and you get lower. And you could take that, you know, if you really have to trade crypto, take it mine along. I'm not entirely interested in crypto. I know there's a lot of hype and people love it, but, you know, you can trade anything really as long as you just adjust that risk. Crypto often is a HVA, so the risk has to change. All right. And you definitely need risk plans with that. That goes without saying. If you're trying to trade crypto, no risk plans, it can really get ugly.